No, it looks like the attendees joining are starting to level off, so I figured we would get kicked off. Thank you everyone for joining us. My name is Moish Peltz. I'm a partner at Falcon, Rappaport and Berkman, where I work with one of our panelists, Matthew Rappaport. Just real quick, legal disclaimer, this webinar may be attorney advertising. It's not presented for legal advice or legal opinion or tax opinion. Before any attorneys can provide legal or tax advice to any person, attendee, entity, or before an attorney-client relationship is formed, there must be a signed fee agreement setting forth the scope of representation and the fee charged. And this webinar is not eligible for CLE or CPE credits. With that said, I'm really pleased everyone's joined us, and I'm even more pleased to welcome our three panelists. Today we have with us Seymour Goldberg, senior partner in the law firm of Goldberg and Goldberg PC of Millville, New York. Mr. Goldberg is also a professor emeritus of law and taxation at Long Island University and recipient of the American Jurisprudence Award in Federal Estate and Gift Tax from St. John's University School of Law. He's also authored 4 manuals for the ABA on IRAs and trusts. Thank you, Cy, for joining us.
Thank you for inviting me.
We also have with us Henry Montag. Henry is an independent certified financial planner in practice in New York and Long Island since 1982. He has written over 100 articles regarding the subject of life insurance for professional publications, and he has recently co-authored a book for the American Bar Association titled The Advisors and Trustees Guide to Managing Risk. Thanks, Henry, for joining us.
Thank you.
And last but not least, my partner, Matthew Rappaport.
Oh, trust me, I'm least.
Last and least, my partner, Matthew Rappaport, who I have the distinct pleasure to work with day in and day out, is the vice managing partner of Falcon, Rappaport and Berkman, where he chairs its taxation and private client practice groups. He concentrates his practice in taxation as it relates to real estate, closely held businesses, private equity funds, and trusts and estates. And that's our panel. So with that said, we're going to kick it off to Cy, who will get us started.
Yes, good morning. Welcome to the program involving IRAs and trusts and related matters. And it's a pleasure to be here with you. I'd like to first speak as to the Secure Act and bring you up to date with recent developments for about a minute or two. There is a pending proposed regulations that will be coming out, I would suspect, within the next month or two, which will detail the rules that apply with respect to IRA distributions, use of trusts, and rules with regarding how to draft a trust, in a sense, by giving you the key elements of it. But these rules will probably will affect 40 to 50 million IRA owners or more with respect to how to handle their post-death distribution rules. So what I'd like to do very quickly is, if you have my outline, Moshe, I understand they each have a copy of my outline. Am I correct on that?
No, Cy, they have not received the outline. I can share it on the screen.
Oh, so why don't you share it then? Why don't you share it? I'm sorry. If you look at page 1 of the outline, which is an overview, and can you put up a page 1, Mike?
Yes, I am sharing it up on the screen right now.
Oh, that's great. That's great. In any event, the next page, my credentials you can disregard. The overview is important. The first few items don't take much to talk about. Basically, they changed the required beginning date rule. If you attain 70 and a half after 12/31/2019, the required beginning date now is April 1st after you've attained the age of 72. And there's really not much more to say with respect to that. The Secure Act did not change the uniform lifetime tables and a lifetime rule. So that's easy to read and nothing more to say about that. The third bullet repeals the maximum age for making contributions to traditional IRAs for years after 12/31/2019, regardless of your age. No longer do they preclude you from making a contribution when the year you attain 70.5. If you're 75, 80, and you have earned income, you can make a contribution to a deductible traditional IRA without any issue. The next bullet is a key bullet. Basically, I'll be writing a trust guide in this area for nationwide distribution for training programs and another guide for the accounting profession. But basically, this one probably is the key to trust drafting, asset protection, and being able to avoid the prohibited rules that the secure has with respect to payout stretch payment rules. So let me go through it slowly. If an IRA owner dies before his or her required beginning date without having a designated beneficiary or eligible designated beneficiary, and we'll go into those terms in a moment, then the 5-year rule under prior law is still applicable. And this applies when you have an IRA owner who passes away having his estate, which you certainly don't want. That's a tax trap and an asset protection trap as well, loss of asset protection. If you have a charity as a beneficiary of an IRA, then there's a 5-year rule. And if you have a non-qualifying trust as a beneficiary of an IRA account, that also triggers a 5-year rule. Now, no one in their right mind should have an estate as a beneficiary of an IRA account. Number one, you lose all your asset protection. But going a little bit further, many people don't realize, and this goes into the area of why many beneficiary forms are defective. Basically, what happens is there have been many cases where people don't fill out an IRA beneficiary form properly, or they were never filed with the institution. But there are court cases involving that. And basically, many of the prototype IRA custodial agreements then states if an IRA owner doesn't select a beneficiary or does an improper beneficiary selection, then in that event, the IRA agreement has default language that says if you don't do anything right, then the IRA agreement at Fidelity or Vanguard or UBS or Pershing tells you where it goes. Now, some of these institutions go like this. If you pass away without picking an IRA beneficiary, then it goes to surviving spouse. But wait a second. What if surviving spouse is a prenuptial agreement to say they're not entitled to inherit anything, but the IRA owner doesn't fill out the beneficiary form properly? And it was a court case, believe it or not, where they didn't fill out the beneficiary form the right way, and bingo, it went to the surviving spouse because the IRA agreement said that if you don't have a valid beneficiary, the surviving spouse. And in this particular case, the surviving spouse was not intended to get the money, just married the IRA owner 2 months after he tried to fill out a beneficiary form, but he picked the wrong Benny. He said in the beneficiary form, payable under the terms of my will. And the court rejected it in its entirety, saying it's invalid. And in this particular institution, it said, if you don't have a valid beneficiary form, the surviving spouse gets the money. Surviving spouse was married just 2 months after, just 2 months, and then that took place. The surviving spouse got all the money. So you have to be very careful with respect to the beneficiary forms. I have attorneys I know who never check the beneficiary form when they do an estate plan. Well, that's a big, big boo-boo. And there is an issue of liability. Does an estate planner have to look at a beneficiary form for an IRA account in connection with doing an estate plan? There has not been any case with respect to that, but one day there will be a day of reckoning where if the wrong player gets the money and the estate planner neglects to look at the beneficiary form, there could be a major cause of action and tremendous liability. But forgetting the IRA owner, the real problem is the millions of individuals who inherit an IRA. Typical case, IRA owner dies, picks the child as a beneficiary. Let's assume it's an adult child, and the child isn't too swift in terms of estate planning, doesn't read the prototype document. In fact, I wrote a memo to a client this morning where I looked at the institution's default option, and it said that if the beneficiary of the inherited IRA account fails to do something, the default beneficiary is the estate. So I said to her 3 times, and to her advisor 3 times, you have to have a successive beneficiary filled out by the original beneficiary. So if the original beneficiary there's only $500,000 involved, which is a lot of money. There are 2 beneficiaries of 2 inherited IRAs, each one about $500,000. Neither of them know how to fill out the successive beneficiary form, so that in the event that the first beneficiary dies, the prototype document with this particular organization says the estate's the beneficiary. So I said, if you should pass away and not fill out a successive form, I said, then on your demise, if you died, you had 500,000. Let's assume you took out 10,000, and the other 490 would then go to your estate. You're going to have this is a Florida case. All of a sudden, you're going to have a probate situation. The default's going to be your estate, and you're going to have a lot of problems administering the estate with a short-term payout and that kind of thing. So again, every beneficiary of an inherited IRA must fill out, with the help of counsel or the help of their financial planner, or with the help of their accountant, a successive beneficiary form with respect to the beneficiary who inherits an IRA account. And the problem is, a lot of people don't want to do it. It means contacting the institution, getting a authority to work with the client, having the paperwork done, signed, and sent over, accepted, and then I normally get a return receipt whenever I do that. So just in one little point about whether the IRA owner louses up, it goes to the wrong player. But more importantly, the majority of times in this country is when the beneficiary of an inherited IRA is clueless. And that's a massive, massive mistake. And I've been involved with a lot of those cases, dozens of cases. But the big item is having a non-qualifying trust as the beneficiary of an IRA account. Now, why I'm making such a big deal out of this one point, it's probably the most important point in this whole program. If you have a non-qualifying trust and you draft the trust in a certain way that makes it not a valid, not a valid trust, it's still a trust that receives the $1 million. But there's a way to do it whereby if you have a Roth IRA account and you work out the numbers in a certain way, you can work out a trust which is defective. You can do certain wording and certain timing things, and the proposed regs will come out probably in a month or 2 that will guarantee what I'm talking to you about. But you can work that non-qualifying trust with a Roth IRA where the money comes out in the 5th year following the year of death. So if someone had $1 million in the Roth IRA and you work it a certain way and you make it a defective trust, you can have the $1 million come out in the 5th year following the year of death. So if someone died in 2020 and you go 5 years forward, then all the money would have to come out by the year 2025. Now, if you miss that target date, let's assume there's 500,000 and you're asleep, and it's a defective trust, non-qualifying trust, or whatever you want to call it, and that $500,000 doesn't come out into the trust, by December 31st of the 5th year, which is 2025, or if you died in 21, it would be 26. It's 5 years from the year of death. Then in that event, if you miss the 5-year deadline, there's a 50% penalty. So that if, let's assume there was no earnings and it was 500,000 at the end of 25, and you missed it, you took it out in 26, the penalty for missing that is 50% of 500,000. So it's 250,000, which is a lot of money. Let's assume you miss the next year, and let's assume there's no further earnings, make believe. Then there's another 50% penalty of the 500,000. So the penalty is then another 250. Well, someone came to me and I had to tell them to leave. They had a $4 million penalty, and I didn't want their name because once they tell me, I really don't even want to have anything to do with it, because the client said, well, I don't want to get involved, blah, blah, blah. That penalty now is about $4 million, $4.5 million. This thing went on back 10 years ago, where they missed taking out hundreds of thousands of dollars. And one of the mutual fund companies picked up this issue and told them they better get in a tax lawyer. The only way out of a penalty is to file a waiver requesting an abatement of the penalty, giving a reasonable cause statement. You have to file the 5329, and then you have to do a 2 or 3 page narrative on why it happened. Now, the IRS will be happy to eliminate the penalty. Just had one case where it was about $1.1 million. The person missed 12 years, and they missed taking $1.1 million of IRA distributions from a major account, and a major player was involved. Well, it took me 3 months to write an abatement to eliminate the penalty, which is about $550,000, and it was a pyramiding penalty. So if you work it out to the bottom line, if you have a Roth IRA trust payable to a defective or non-qualifying trust, and that's going to be based upon the pending proposed regs, I know how to do it now, but it'll be solidified in a month or two, then the money goes $1 million into the Roth IRA trust in 2025, and it's tax-free. Or if it grew to say $600,000, then the $600,000 would be tax-free. And then you could draft a trust whatever way you want. You can then say that $600,000 shall be distributed based on the rule against perpetuities in the state of New York, which is lives in being plus 21, basically about 90 years. You could say it goes to A for life, and then it goes to B for life. And then you could say if B dies, survived by issue, it must be paid to issue by 21 years after the death of the second player. But you have to name each player. You name A to receive for life, B to receive for life, and then death of B, it's to the, and issue surviving B, then it goes to 21 years. Therefore, you're going to get maybe a 90-year trust. That's the way to beat the Secure Act. End of story. If you're in Florida, believe it or not, a trust can last for 360 years. So therefore, you could have a Dynasty Trust, and you can have that $500,000 going to $100 million. If you I do work with a Florida, a state of Washington law firm, and in the state of Washington, the rule against perpetuities is 150 years. So you can, in a sense, have a trust going for A for life, B for life, a C for life, D for life, and then you can say, and then you can say something about unborns. So you can have it going like a Dynasty Trust. So what we're talking about, a major thing. You're not going to be, I'm not talking about charitable remainder trust. I'm not talking about anything. This is not exotic. It's straight through. It's a drafting process. If you know what you're doing, I'm doing an address in Seattle in August for about 500 people, attorneys, accountants, financial planners, clients of this Washington law firm. They're sending out, I don't know, maybe 10,000 emails. So the bottom line is that item is, and I don't care what anyone says, this is a way to avoid or get around the stretch payment rules. Everyone's crying. It's not saying, you can't do anything. You got to take out your money. You got this, that. Joe's saying this and that. Everyone's talking about that. It's as straightforward as I'm speaking to you now. It's not a big deal. Now, you can record this, and I am being recorded. And I'm telling you right now, that is the way to do it. Roth IRA trusts are the big game in town, as far as I'm concerned. Next bullet, if you go to that, right beneath that, it starts with Jack, an IRA owner, died 2021 at age 68, before his required beginning date, having selected his daughter, Jane, age 30, as a designated beneficiary. Well, that's the new game in town. A designated beneficiary is an individual being, or that you picked as a beneficiary, or if you didn't do it right, a default beneficiary. You don't want to get involved with default beneficiaries. A default beneficiary may be the children. It may be the spouse. It may be the estate. So let's assume Jane is smart enough to pick a successor. So here's the way it works. And there was a lot of controversy on this point throughout the nation as we speak. If Jack and Ira owner died in 2021 at age 68, before the required beginning date, having the daughter, Jane, as a beneficiary, then Jane must receive the entire IRA account by no later than the end of the 10th year following the year of death. Okay, that sounds simple. Everything is simple when you look at it first blush, all right? So basically, that means that the 10-year rule is triggered. What does that mean? As I said earlier, and I may only cover a half page, Henry, or Moish, or whatever, because I can talk on one point for an hour. But these are important points. So so basically, here's the problem. Daughter Jane is age 30. She told her financial advisor, said, don't take out any money until the 10th year. But what if she dies before the 10th year? Who gets the money? It's the default beneficiary under the IRA agreement if she forgets to pick a successor interest. What she should do is do a form at the institution, say, if I die, I want it to go to my child, my grandchild, my husband. She's got to do something. She has to work on it. And so that's the story with that bullet. What I'd like to do, given the limitation, okay, let's go down to the two bullets below motion, then I'll go on to trust. In the opinion, okay, this recommendation has been made by me to IRS and Treasury. It was passed to them through the AICPA and ACTEC. This point I raise. And what if an IRA owner is, say, 75 and is taking his RMD distributions, but dies before he takes his RMD for the year of death? The question that I'm presenting to IRS and Treasury through ACTEC and through the AICPA is, what if the IRA owner, what happens with the unpaid RMD for the year of death? Is that subject? And I'll be sending this to IRS and Treasury probably next week. And I'm going to underline this point. But basically, the bottom line is that I don't think the unpaid RMD for the year of death is subject to the 10-year rule. I think that the beneficiary takes out the money ASAP, and then the balance after taking out the unpaid RMD is subject to the 10-year deferral. And I guarantee you that IRS will use this opinion. And since AICPA brought it up and ACTEC brought it, well, these pages, just for a plug of my book, comes from my guide, second edition, which is out now. But anyway, I'm not soliciting because that's not right. If you could turn to the page 4 of the outline motion, because I really want to go through the effective use of trust.
Hey, Cy, I just want to mention that you just glossed over the fact that you're in touch with the IRS and that you're in touch with the AICPA. I just want to mention that that's a big thing. You made it sound like Yeah, everybody gets in touch with the IRS. That's very
That
special.
show just said to me over the email, why do you keep bothering the IRS? I said, because I don't bother them. I inform them as to my thoughts. I said, if you like, you could bother them, but they'll yell at you and you'll yell at them. So she didn't like that. But the bottom line is, thank you, Henry. I appreciate that. And what I've done is sent in 6 comment letters to IRS and Treasury on the Secure Act, another one yesterday on a problem area, and then another one next week, and then I'm done. That's it. Because after a while, they think I'm a pest. But so far, I'm okay with them. Thank you, Henry. Anyway, look at the advantages of trust. I'll go rather quickly on that. If you pay IRA monies directly to a beneficiary, then the beneficiary is just going to take the money out and spend it. If they're a spendthrift, they just can't. They can do what they want. You have, if you're ready to have a daughter inherit $100,000 or $1 million or $2 million or $5 million or whatever you want, that's it. The bottom line is, if it's going to a beneficiary directly, but wait a minute now, daughter is going to inherit $5 million or $2 million and dies the next day. Bingo. She never did it before. She never been a successive beneficiary. Successive beneficiary is her husband, who's in the process of going for a divorce, and didn't get around to it. But the day after she inherited $1 million or $2 million IRA, no one ever told her she's got to pick out a successive beneficiary. And the default option in Fidelity and other institutions, Pershing, is a spouse. But the spouse is walking out the door. That spouse is going to get the $5 million. Imagine that. How many people screw up on not doing it? They don't know how to do it. I can tell every person I've spoken to, every child, every spouse, they said, what am I talking about? Well, you know what? That probably is the most important thing. You have to know the Secure Act, the mind-boggling 100 pages of regulations that are going to come out, maybe 75 pages, maybe I'm going too high, maybe 50 pages. I said between 50 and 100 pages. You barely can get through that. On top of that, you don't know what you're doing in terms of transferring wealth. So what good is it? Number 2 is a hot button, and I'll go real fast with that. Malpractice in this area is massive in scope. One of my comment letters is systemic errors. This is a systemic issue. An IRA payable to a trust. Knowledgeable trustee can take an extended payout period. I would say a limited. I've changed my outline to say a limited extended payout period. Limited instead of extended payout. But here's the problem. You can't even use the trust if you don't file paperwork with them by October 31st following the year of death. Because if you don't do that, then you can't use the extended period at all. You're in a real problem area. And I will tell you right now that there's not been one audit at the IRS level on an audit of an IRA trust that I'm aware of. And I'm on a committee of like 10 people, and I'm telling you, there's never been an audit. I'm not aware of one audit in the country. Well, guess what? There are thousands of defective IRA trusts in this country. I know that for a fact, because people wrote these boilerplate trusts, IRA trusts, and never said you must file a copy of the trust document with the IRA institution or send in certain disclosures by October 31st following your death. And you know what? People have died years ago, and the trust is worthless, and the penalties are, and I put this in my memo to IRS and Treasury, that there are systemic issues in the country and that you have to give them a break and set up some type of system where they can pay a small fine and not be destroyed. Because you know what? Those IRA trusts are sitting with millions of dollars of penalties with no statute of limitations. And accountants have told me at programs I've given that the trust documents were never filed. They never knew about it. And this goes back 10 years ago, 5 years ago. And I told them, you got a real problem. So if IRS doesn't give you a break, what are all these accountants going to do now when the trusts are illegal? And they've been filing trust returns. Not only do they have a Circular 230 violation, the trustee's got unlimited liability and it's personal. So I'm going to be pushing Congress, if I have to, and IRS and Treasury, and I have recommended a sort of a nunc-pro-tunc, which means a retroactive curing of the defect, because why should that trustee doesn't even know anything? He's clueless. She's clueless, and that's my memo. And how can you have them hung out to dry for hundreds of thousands of dollars of liability with no statute of limitation? So I'm asking IRS and Treasury to please come up with a special IRS program where people, the trustee can apply, pay a $5,000 fine, and then become retroactively relieved from liability. The only way to get around it, if IRS doesn't do it, is go to Congress. I would. Or another approach is you got to take all your money out right now, file retroactive penalty abatements for 5329 for 10 or 15 years. The fee for doing that might be 30, 40,000. For doing that, explain to the IRS we don't want the 50% penalty. We don't want the beneficiaries wiped out. We don't want the trustees wiped out. So this is really the school of hard knocks. Literally, Matt Rappaport was listening intently, taking notes, and we're going to do programs all over the world, right, Matt? And
All over the world.
How about
on every continent, including Antarctica.
Okay, good. Or another way to do it is put in claims for reward. You follow? And the rewards can go up to a certain amount. You can even, retire just on a reward basis of anywhere from 10 to 20%, I think you can get, depending on the amount involved. But one could have a retirement annuity, Henry, without having a retirement account by being a tipster. But that, of course, is unprofessional, illegal, and you can be disbarred for doing that. So I'm sworn to secrecy. So strike all those remarks. I should take that off the recording device because I don't want to be subject to a ridicule. But any event, I could go on and on and on. I do think I've used up my time, and I apologize for being too slow on the trigger. And I want to thank you all for listening. And if you have any questions at all, you can contact me or Henry or Matt at your leisure, and be happy to discuss it. But you do get 1 minute or 2 minutes free, but then we charge our appropriate hourly rate. I want you to know.
Hi, there's a good question for you in the Q&A box. So I want to read this question to you because it's a good one. Question from David. He says, I must have missed the essential variable that enables an IRA trust to override or sidestep the Secure Act. Can you briefly repeat the essential consideration that would allow an IRA trust to do this? I did not realize that a Roth could escape the act in the manner that you described under your trust planning scenario.
What happens is if you have a Roth IRA, and is this an attorney question or is this from an attorney?
David, if you could chime in describing your practice and whether you are an attorney or an accountant, which types of matters you work on, that would maybe be helpful. We'll wait for him to chime in, but in the interim, Cy, if you want to launch into it, I'll relay his answer.
Oh, okay, fine. Bottom line is this: when an IRA owner has a Roth IRA, he's deemed to have died before his required beginning date. And if you look at the fourth bullet, if you're an IRA owner, but you're a Roth IRA owner, you're always deemed to have died before your required beginning date. Is that right? Because that's the law. Because there are no required minimum distributions while you're alive. So you are deemed as a matter of federal law to have died before the required beginning date. So if you die before the required beginning date, make believe you have an estate as a beneficiary. And you have an estate as a beneficiary. Then the money must come out in its entirety by the end of the 5th year following the year of death. Got it? Okay, but what if you have a defective trust? A defective trust is a trust, but it's defective. It's like an estate. And therefore you die in 2020 with a Roth IRA, the money is got to come out to the trust by no later than the 5th year following the year of death. And that's the whole story. Am I missing something, Matt, or are you exercising? Or In any event,
No, I'm not exercising, but I felt I might be able to get a better angle. Maybe yes, maybe no. Because I was sitting down and I was just like, I'm not taking up enough of the screen. So I figure maybe if I do this, I think I don't know. Moish, thoughts? Yes, no. Should I go back to sitting? Should I? Moish will be the arbiter of whether or not this angle works better.
Whatever makes you comfortable, Matt. I want you to be comfortable. That's what's most important to me.
That was a great question. That was the most important thing you can have out of this course, because once it's out there in terms of the webinar programs and manuals and trust guide. I'm writing a trust guide, a 50-page trust guide now on use of trust in estate planning with respect to IRA accounts. And I'll have probably a lot of details on accumulation trusts, drafting approaches to that, a defective trust, conduit trusts, if you're not worried about the heir getting it in 10 years, and things of that nature. By the way, you're going to want to trust no matter what, because what happens is if you have an IRA trust, even for Jane, designated beneficiary, she doesn't know what she's supposed, or for whoever we pick as a beneficiary. If you have a trust, the trust's going to say, if Jane dies during a 10-year period, it goes to Charlie as the remainder. So even if they want just a 10-year trust for the daughter, if the daughter is 30, they don't mind her getting it at age 40, but they don't want her getting it till 10 years from now. So you can say in the trust, if my daughter Jane survives me and dies within 10 years from the date of my death, and she has not received any distribution pursuant to the terms of the IRA trust during the interim period, or if she has not taken all of it, then in her demise, the remainder shall be her child, not her husband. So that the 10-year trust will be a big item for the many IRA account holders, the one that's got many. If you have maybe 100 or 200, 300,000, you may not want to have an accumulation trust that can go out for 50. Now, what's an accumulation trust? A trust that's got one beneficiary, another beneficiary, another beneficiary, same as the Roth. But you can work it out whereby it goes for 10 years and 10 years and 10 years. We have a 10-year trust, it drops into the bucket after 10, then it can go to B and it can go to C. But the problem with the accumulation trust is in my opinion, you're going to have to name a series of beings, a series of A, B, C, and D in the document. With my approach, you could even have, with the defective Roth IRA trust, you can have unborns, because the IRS doesn't care. As long as you satisfy the rule against perpetuities, then you can even have a class. You can say in the cases I'm doing in, say, Florida, with the attorneys in Florida, or in Seattle, Washington, I can say in a Roth IRA trust, it goes for A for life. If B, and then for B for life, and C for life. But if all of them die, then it goes for the issue of the last one to die, for example. They may be unborns, so I don't care. Because in the state of Washington, you have a 150-year rule against perpetuities, which means the trust can last for 150 years. In Florida, it's 360 years. In a lot of states, there is no rule against perpetuities. Yes, stop. I stopped.
And I don't know if you saw, but David chimed in that he's a licensed attorney and financial advisor involved with investor protection services for clients and their advisors. Thanks, David, for.
Okay, great. So I hope I made myself clear. But in a state like Florida, you do a defective Roth IRA trust, you can go for 300, you can go for 360. But a lot of states have no rule against perpetuities. A lot of states are Dynasty Trust states.
You could go for 360 years as well. So let's hear from Matt.
I'm trying to get there. Hold the fort. Anyway, the bottom line is what I just said to you is going to be the big game in town, I can assure you, until it's plugged up. I'm sorry, I didn't mean that. But anyway, I want to thank you all for listening. And by the way, the way to keep that after the 5-year rule, you work out in drafting, you work out mini distributions, not to get involved with big tax brackets. You can work the trust where you don't get trapped with trust rate. There's all kinds of things that are in my manual. So buy my next manual. Anyway, thank you again.
Thank you, Cy.
You're welcome. I'm gone. I'm finished.
Moish, our
My
fearless
daughter-
moderator, cue
What?
up the next steps here.
All right, Matt, are you going up next? Let's go.
I'll be all right. You tell me how much time I should take.
Why don't you go until about 12:50 and we'll leave Henry the last 15, 20 minutes.
20-ish minutes, no problem. So what I will handle for the next 8 to 10 minutes is upcoming proposed legislation, the likelihood of it coming through, and what type of content it may contain. So let me give a brief overview in terms of what's on the table and what you should be concerned about in terms of changes that will occur to the federal estate and gift tax regime. So first thing, what everybody is probably most aware of is the infrastructure proposal running through Congress that is being really pushed pretty hard by the Biden administration. And that infrastructure bill has tax provisions in it. Those tax provisions are almost entirely on the income tax side. There's a lot there in terms of what that would do. One of the major holdups is whether or not the more centrist Democratic members of Congress, mostly folks in the House, the Senate is not as concerned with this as the House. There is a pretty vocal contingent in the House, enough of a block to actually prevent the legislation from passing, that wants the state and local tax deduction reinstated. I don't see that as practical. That is where a lot of the attention is being focused, but the estate and gift tax bills that are actually winding their way through Congress and being proposed both in the House and the Senate, there are 2 acts that are in draft, and they don't have as much momentum as the infrastructure bill, but they're out there. And you would need to see whether or not these acts would be integrated into the infrastructure bill, whether or not they would be tabbed as potential revenue raisers, and if they pass, what form would they pass in? Those 2 acts are as follows. Number 1, there is the For the 99.5% Act that is very heavy on estate and gift. And then the other act, which is basically a different side of the same coin, is what they call the STEP Act. Let me tell you in the aggregate what these 2 acts would do. They would change the paradigm for estate and gift tax planning completely. And they would take certain strategies that we all know and love, and they would eliminate them. And for other, for other different considerations, they would change the way that those strategies would have to be implemented. So some of the strategies would go away. Let me describe what those would be. One of the things that's pretty popular among the ultra high net worth is the concept of Dynasty Trusts. Cy was actually just mentioning the function of the rule against perpetuities when it comes to IRA trust planning. However, there are certain states that have eliminated or greatly lengthened the time of their respective rules against perpetuities. So for instance, a state like South Dakota has repealed entirely its rule against perpetuities. So South Dakota is a popular jurisdiction to establish a Dynasty Trust. A Dynasty Trust is a trust that basically lasts forever. And the advantage to establishing them is that the generation skipping transfer tax is only levied once. So when you set up any trust and you use your generation skipping transfer tax exemption, if the trust lasts theoretically forever or across 4 generations, 5 generations, 8 generations, the generation skipping transfer tax only applies once. The way that the For the 99.5% Act would actually treat this is Dynasty Trusts would basically be, at least for tax purposes, terminated as of a certain time. And it would allow the transfer taxes, meaning estate, gift, and generation skipping transfer, et cetera, et cetera. At minimum, they would try to apply the generation skipping transfer tax again. So what they would say is, as far as Dynasty Trusts are concerned, this is all well and good, except for the notion that we want those Dynasty Trusts to eventually end. Because the transfer tax advantage of Dynasty Trusts as they are now is that once the money or other assets are in, and the generation skipping transfer tax and the estate tax exemption have both been applied, or the gift tax exemption as it may apply, then the money in effect would be exempt from transfer taxes forever at that point. If the GST inclusion ratio is 0, then you don't have any transfer taxes anymore. And this act would seek to end that treatment. In addition, the act would also say that any trusts that are grantor trusts under section 671 through 679 of the Internal Revenue Code. We all love sales to grantor trusts, right? The great thing about them is that under Revenue Ruling 85-13, when you sell to a grantor trust, if the grantor trust is structured correctly, it's outside the taxable estate, but the transaction does not incur income taxes for the grantor or the trust, because the trust is considered the alter ego of the grantor. In this legislation, grantor trusts would both be explicitly excluded from the step up in basis, which I believe is the case now if the trust is not revocable. So in other words, there are some folks out there who advocate for the position that if you have an irrevocable grantor trust set up by a United States grantor, then the grantor trust assets at the time that the grantor dies both are outside the estate and get a step up in basis, which I don't believe is the case. The only time that's the case is when the grantor is a non-United States person. Other than that, if you have a United States person as grantor, you can't have your cake and eat it too. You can't get the step up and exclude from the estate, right? It's one or the other. So in this legislation, grantor trusts would be considered inside the estate, and that would be a major problem. You would have an irrevocable grantor trust, not a revocable one, an irrevocable one, where the assets would be included in the estate. When you couple that with the STEP Act would say it's included in the estate, but the STEP Act also would get rid of the step up in basis and say, not only would there would not be carryover basis at death, right? People would shrug their shoulders and say, well, if you don't have the step up, wouldn't you just have a carryover event? It's actually not the way the step act actually wants to do it. The way the STEP Act is written is that the STEP Act says, not only will we eliminate the step up in basis tax-free, we're actually going to achieve the change in basis by taxing capital gains, making it a recognition event when there's a transfer at death, right? And that would be an enormous paradigm shift at that point, because right now you get basically a double benefit. As long as you avoid the estate tax under present law, you are able to get the step up in basis, and you're able to avoid any sort of recognition event when you are passing assets down at death. Here, however, under the STEP Act, they would try to make death some kind of recognition event, which is crazy. And the alternative, even if you had a watered down version of that act actually passed, and you were to eliminate the step up in basis and make death a carryover basis event, that would be a huge change, because under current law, the reason why you want to leave things in somebody's estate up to the exemption amount is in order to get the step up in basis without assessing an estate tax. On the other hand, however, when it comes to the carryover basis, you wouldn't want to leave at that point anything in the estate, because there would be no step up. And if they pass the act as it's presently written, there would actually be a recognition event at death, and that would be terrible. So you'd want to get assets out of the estate. But the 99.5% Act would lower the present federal exemptions, which is $10 million indexed for inflation, set to sunset back down to half of that amount in at the end of 2026. But now, under the 99.5% Act, that would be $3.5 million per person indexed for inflation, which would bring us to that level. Has never actually been passed into law before. We had a pretty big increase overall, right? Up to $5 million. And after the fiscal cliff events of 2012, that was made quote unquote permanent until the Tax Cuts and Jobs Act. But now you would have a $3.5 million per person exemption. On the federal level, that would presumably still be portable. Contrast this, however, with New York State. You may have heard about New York State's new budget bill that was passed very, very recently, signed into law by Governor Cuomo. There were several seismic income tax changes that were part of that bill. What was not part of that bill was the state tax changes. So you still have a non-portable $5 million per person exemption under New York State law indexed for inflation. If these estate planning bills were to pass, even in some kind of watered down form, and you got a $3.5 million per person exemption indexed for inflation, Think about the implications if the New York exemption is actually higher than federal. The question will become, would you want to set up AB trusts, right? We prefer Clayton Q-tips. That's what we like. You may like that. You may like disclaimer trusts. You may like just plain old vanilla credit shelter trusts. Ask yourself how you would fund those trusts at the first spouse's passing. Would you want to take a state level hit in order for the appreciation on those assets to be outside of the second spouse's estate, to get other sorts of benefits that may come from removing those assets from the estate? And would you take the hit, right, on the federal level? I got it mixed up. On the federal level to avoid what may happen at the state level? Probably not, but you'd at least have to think it over. In certain situations, it may not be so clear cut, right? Because on the federal side, you'd say, okay, the 3.5 million ports, but would you want to use any part of the 3.5 million? Would you use only the 3.5 million and leave the other 1.5 on the state level unused? Would you use the state level exemption and take the federal hit? You'd really have to start modeling this out. And I have a feeling the right answer is going to be different depending on the size of the estate. And you really have to do some very granular math in order to figure out what the right planning would be. If you're thinking on the planning side, and I'll take another minute or so before I turn it over to Henry. If you're thinking on the planning side that some of these strategies you may want to use to address that new environment would include valuation discounts, would include certain freeze strategies. We already talked about the idea that grantor trust planning as a freeze strategy would no longer be effective. The other freeze strategy that would be affected is a grantor retained annuity trust, or GRATs. Under this legislation, GRATs would need to have a minimum term of 10 years, making them much less attractive. The strategy I want to throw out there that would not be changed by any of these bills would be Section 2701, which is the freeze partnership. If you're not familiar with freeze partnerships, one of the things that you may want to do is you may want to get yourself familiar with it, because in my opinion, if these acts pass with even half the content that they have, and don't underestimate their chances of passing, by the way, if they pass with even half the content that they have, the way I see it, freeze partnerships will become the dominant strategy for holders of real estate portfolios and business interests during their lifetime. And they will take the place of grantor trusts and GRATs, which are the predominant strategies that are being used in this environment. Freeze partnerships are complicated, but they're very, very effective once you get clients to wrap their heads around it. So be on the lookout for that stuff. And from here, I think what I can do is I can pass it over to Henry, who will talk about the notion of what is going on with certain life insurance policies that are out there and the different problems you might not be aware of as advisors and how you should address them. So Henry, you can take it away from here.
Yeah, that was very informative. Very informative. And as soon as I get my thing up here. Okay, so first off, thanks. I'd like to just thank co-presenters Cy, Matt, again, incredible presentations. I'd also like to thank the law firm Falcon, Rappaport, and Berkman for sponsoring this. And having said that, I'm going to spend the next 15 minutes trying to give you a executive summary of some of the items that were mentioned in this book that I was privileged to co-author on the subject of life insurance. And let me just try to move ahead. I'm not able to forward my slide. Let me just see why I'm not able to do that. Hey, Moish, any help here?
Yeah, if you can click the right arrow down to the right a little bit on the white base bar there. If you can't select try clicking on the presentation and using your arrow keys, right to left might also work as well.
Not able
like
to.
Like a normal left click on you can click next there, and that'll go advance. But should be able to use your keyboard to press right or left on it.
Yeah, keyboard's not working. Let me try to do this here. Okay, I'm sorry about that. I'll just use that instead. Okay, so again, things we're going to be talking about are the fact that some types of life insurance are good for death benefits, others are good for living benefits. We're also going to be talking about the idea that there are current problems in the insurance industry, primarily the fact that many insurance policies, because they were not guaranteed, are basically expiring before the individuals that they're insuring. And we'll talk about why that's happened as a result of what I call the unskilled trustees, who are basically unaware of what needs to be done. And we'll, of course, talk about some useful strategies that could be used to resolve those problems. We'll talk about the use of death benefit for the beneficiaries, provide a case study on that, and see how that works in with the Secure Act. And we'll also see about the idea of using life insurance to be able to pay for the increased estate taxes that Matt just alluded to, as far as dropping down to $3.5 million. I don't even want to talk about the carryover basis or losing any of the other options. And we'll also lastly talk about the living benefits of life insurance, which can be used for the insured. And again, that's an item that most people are unaware of. I am not able to. Okay, so why does the subject of non-guaranteed universal life insurance, why is that such a problem? Well, prior to 1980, there were only two types of life insurances. There was something called whole life and something called term insurance, and they made up 100% of the market share. And they were both, of course, guaranteed. In the early 1980s, E.F. Hutton, of all people, decided that they wanted to take advantage of the fact that interest rates were up in the stratosphere. If some of you may recall, interest rates were up in the 1819, got as high as 21%. So E.F. Hutton created this new type of insurance called universal insurance. And the premiums were based on, at the time, a significant interest rate. As I mentioned, 12, 13% was nothing to be ashamed of. And when interest rates, however, declined, people weren't aware that they should have increased the premiums. So the insurance company just went ahead, billed the same premium, the death benefit stayed the same, which resulted in a shortened duration of coverage. And as I say, the owners of the trustees should have increased the premiums, but they didn't know that they should have. And as a result, an increasingly number of coverage is expiring prematurely. And let me give you an example of that. Individual purchased $1 million worth of life insurance, 1991. Interest rates were quite high back then. People wanted to use 10, 12% figures. Let's assume somebody compromised and settled on a 9% figure. Well, the cost to purchase $1 million of coverage to age 95, not guaranteed to age 95, but to 95, assumed based on the 9% interest rate, would have been $14,000. In order to avoid the state taxes, conversation took place. Who should be the owner? We don't want to have you be the owner. Well, let's use my oldest son and daughter. And they went ahead and they had the application signed. However, there was no mention of the fact that the rates were not guaranteed, nor that the duration of coverage could have changed, nor that the interest rates could have changed. No talk about the idea of active management. No talk about trustee qualifications, whether or not he or she may have had this specialized knowledge and skills, and certainly no ongoing responsibilities, let alone personal fiduciary liabilities for not monitoring the situation. So fast forward 30 years later, well, the 8-9% interest rate certainly wasn't achieved. In fact, it was actually 4.1%. And currently that $14,000 premium, that would expire next year or at the end of this year when the individual reaches age 86. Today, the premium needed to cover that same $1 million to age 95 would virtually double to $26,000. At the current premium, that only buys $450,000 to be able to get them to age 95. And this is the result of what I call a buy and hold strategy as opposed to a buy and manage. Non-guaranteed universal products are a good flexible product, but they don't come with automatic self-management. Wall Street Journal had this to say. Senior editor wrote, she's written multiple stories, but people are just not aware that they should be managing, and let alone the fact that agents or brokers that may have been involved 10, 15, 20 years ago are no longer there today. What does the insurance marketplace have to say about this? Well, the general counsel for IMSA, gentleman named Donald Walters said that while the insurers have not publicly publicized the issue, there's a growing concern of the industry about lapsing universal policies. Can the insurance industry have done more or currently do more? What you have here is a page 3 of a 6-page annual notice. And if you notice all the way at the bottom of page 3, in big bold letters, it says important notice. And in even smaller print, it talks about the idea of a change of interest rates may affect, they don't even say that it will affect, may affect the duration of the coverage. Well, it certainly does. My observations, certainly the insurance companies could have done a better job of communicating. Instead of putting that important notice on the bottom of page 3, they should have thrown it up on the top of page 1 in large print, letting people know that there is a problem, that may be a problem. And the agents should have been directed to better serve the client. And keep in mind too, the insurers benefit when policies expire. Basically 9 to 11% of insurance companies' profits come from insurance policies expiring. So trust-owned life insurance is a wonderful vehicle, tax-free, leverage, risk-free transfer mechanism. It's a sophisticated tool. It provides creditor protection management, and it's ideally suited for trust ownership. But life insurance policies are not managing, and life insurance policies inadequately funded do lapse prematurely. How long the contract remains in force depends on several options. First one is the advisor's role. Let's look at the attorney. The attorney is wonderful in terms of gathering all the relevant information, reviewing client intentions, discussing the named beneficiaries, trustees, discussing the crummy powers, discusses the role of the duties of the trustees. But basically, life insurance is a orphan child, and no one talks about the idea of monitoring it, reviewing it, actively managing it. No one talks about the fact that future premiums may have to be adjusted. And unfortunately, not too many people talk about the trustees' personal fiduciary liability if and when they're sued. The CPA role confirms whether or not life insurance is required, confirms whether the current cash is available, may prepare the current provisions, but again, doesn't get involved in the annual monitoring or the ongoing performance of the evaluations, and certainly doesn't talk about the adequacy of future premium payments. No one does. The private trustee's role. Again, he's asked to sign a document and often files it away in the bottom left-hand drawer with the insurance policy, unaware of the need to monitor, doesn't have the skills, unaware of the fiduciary liabilities, unaware of the performance risk that they are 100% responsible for. And the list just goes on. And oftentimes the trustee, as I say, oftentimes the son of the daughter, assumes that everything's taken care of by the grantor's advisor. Now, for those attorneys out there, this is an important point. It's important that the trustee does not think that just because he is acting as trustee, that he is covered by his father or mother's or grandparents' advisors. Many people have incorrectly assumed that. And everything that I just mentioned above reduces the duration of coverage. A couple of questions that the trustee should be asking himself or herself: have they adopted a written investment policy? And let me just move on to this. There's good news and bad news. It's an honor of statement of trust. It's an opportunity to manage all of the trust's assets. And it's an honor to be the person chosen, take care of the responsibilities to the family. But the bad news is the trustee is held to a higher standard of performance, but as I say, unaware of their liabilities and unaware of the personal liability that they've accepted. On the other hand, the institutional trustee, well, they have no problems because they're regulated by the OCC, the Office of Control of the Currency. And they in turn annually monitor everything that should be done, and they fulfill their fiduciary responsibilities, and they manage the liability, and they increase the premiums if need to, because they need and want to maintain a good relationship with their clients. And they certainly need to avoid any damage to the corporate trustees organization's reputation. Are they familiar with all the relevant responsibilities? You bet they are. And if they're not familiar, then they know that they have to go out and obtain the necessary skills and contract for those additional skills that they may not have. So why is the life insurance audit needed? Basically to take care of everything that I just mentioned before. It examines And to prevent this, how's this matter handled in your office? You've got a client coming in, and all of a sudden he's got a $2 million life insurance policy and gets the letter that it's going to lapse next year. Insured is currently 82 at an average health. Currently, he's paying a $29,000 life insurance premium, but that's now not sufficient. He's now going to pay $38,000, and they've already paid $580,000 to date. What do? What would you tell your client to do? Well, if there's a problem with the policy, the client should obtain, or an advisor should obtain, an annual summary statement, a historic projection, or engage an independent broker to evaluate what the annual summary statement and historic projection speak of. Basically, a client has 5 options. 1, they can reduce the face amount of the insurance policy. 2, they can pay a higher premium. 3, if the individual is healthy enough and if it makes economic sense, he or she may qualify for a new contract. 4, they can sell the policy to an institutional investor, and instead of having a bill, turn it into a asset, or some sort of combination of the above. Now, to prevent the problem from happening, well, there are 4 things that my office goes by. 1 is the UPIA, which basically says that all assets have to be treated equally, including life insurance. 2, an investment policy statement. What's the grantor's purpose for this policy? What's their risk tolerance? What are they doing as far as gifts? What's their preference in the event that there's a problem? 3, an insurance performance evaluation is vital. It verifies the facts regarding the insurance company, their ratings, their past policy performance. Have they increased the cost of insurances? Might there be a oncoming increase in cost of insurance and dividends, which again are not guaranteed? What has been their dividend history? An adequate funding statement is certainly something that the accountant could and should get involved with. It defines the required premium needed to guarantee that the policy is adequately funded to a particular specific age. Keep in mind, the longer you want that policy guaranteed to a specific age, the more it costs. People might say, well, sure, I want my policy guaranteed to age 120. I do have to remind them that unless they think they're going to make it to 120, might be better off perhaps considering age 100 or whatever the case may be. But what this does is it provides that the trustee has demonstrated their prudent fiduciary responsibility in the event of a future lawsuit. Let's just look at 1 or 2 outcomes of reviews. Very simply, here's an individual who came in paying $24,000 premium for $1 million worth of coverage. He was listed as a smoker, and all of a sudden in our conversation found out that the individual stopped smoking 5 years after he purchased the policy. Well, in 2020, we renegotiated that $24,000 premium, which only took the contract to age 84, to a $21,000 premium. But more significantly, we increased the guaranteed coverage to age 90 as opposed to age 84. Secondly, individual who wanted to provide a inheritance for his children, had no interest in collecting or in using any of the cash value. He just wanted to provide the highest death benefit to his children. Well, he had the right idea. He had a second to die policy. But when I looked a little bit closer, I realized that it was a whole life policy. And as we know, whole life policies accumulate cash value. So by changing that from the accumulated cash value of a whole life policy into a guaranteed universal, we were able to take that same $16,000 premium and convert it from a $1 million policy to a $2 million policy, guaranteed to age 97. And by the way, we'll talk about this in a few moments, but we were also able to add a long-term care rider. Basically doubled his coverage and added some significant benefits. Other lawsuits, well, these are just a few that I recently picked up. I'm not going to go through these because it's just going to take a little bit too long, and I want to leave some time for questions. But there are certainly lawsuits, and I just want to spend a moment on the idea of using insurance to offset the future liabilities, as both Cy and Matt mentioned in terms of the Secure Act. Example, currently male age 25 inherits $1 million under the old rules. He would have been able to have taken that distribution over his life expectancy of 57 years would have taken out 17,000 in a 24% bracket. He would have paid $4,000 in taxes. Under secure, with a 10-year withdrawal, that same 17,000 would be kicked up to 100,000 in a 24% bracket. That tax bill would have been 24,000, approximately 20,000 more per 100,000. $20,000 times 10 years is $200,000 per $1 million. You have an individual with a $5 million life insurance policy, and all of a sudden there's an additional $1 million future tax liability. Life insurance is in terms of a best strategy to be able to pay for that. A guaranteed universal to age 100 with a second to die policy, because again, that number, that $100,000 withdrawal is not needed until the end of the second death. Guaranteed universal, what's special about it, unlike the previous universal policies, these are now guaranteed policies. We make certain, the insurance company certifies that the premium selected is sufficient to guarantee the coverage to a specific age. It's the least expensive way to provide the maximum death benefit, and it's best used to pay the future tax liabilities, as well as, of course, future estate taxes on IRAs and all assets. Using IRA to pay assets, to pay estate taxes, again, it's a no-brainer. Best alternative is to be able to use the RMDs, and again, I won't mention names, but there are many smart individuals who agree that the best use for the RMDs, if you don't need them to live on, is to use it to buy life insurance to pay future estate taxes. The value of the life insurance is excluded from income and estate taxes. The value of the insurance is guaranteed, and the death benefit, of course, is significantly leveraged. The idea of a second to die policy, since funds won't be required till the second death, this type of strategy is available with all policies, with the exception of term insurance. The cost with a second to die policy is significantly less with a second to die than it is with a first to die. Example, male age 78, individual cost for $500,000 is $31,000. For female age 74, individual cost is $18,300. Second to die cost for both is $14,000. I see we're running close to the end of the time. I'm going to have to basically begin, just for courtesy, just slowing down at this point. We do know that estate taxes going forward, as Matt mentioned, probably will drop down to $3.5 million. Who knows what may happen with the stepped-up basis, but we do know that the cost for estate taxes will increase for many. They're due and payable within 9 months. And again, the second to die option is the best option in terms of paying those. I'm going to just leave it off here. I'm sorry, I'm not going to be able to get to the living benefits from life insurance. I'll just very quickly say that they're basically going to be used to be able to supplement one's individual retirement, whether it's an executive, a SERP, a supplemental executive retirement program, or if it's a business owner, a SORP, supplemental owner's retirement plan, basically to accumulate taxes. And we can do that on a total discretionary basis. We can use the living benefits to pay for life insurance, to pay for long-term care directly from the death benefit of life insurance policy, tax-free. And lastly, the last living benefit is the ability of being able to sell a policy. And as I said earlier, turning a bill into an asset. It benefits not the insured, it benefits not the beneficiaries, but it benefits the insured, and he or she is able to obtain a higher payout. Again, I'm going to stop here and just say thank you and open the and turn the conversation back over to Maish. And I just will say, this has been a tease. This has been, basically trying to provide some information. If anyone is interested in some additional information, as Cy mentioned, they can certainly get in touch with us. You can obtain the handouts. If anybody is interested, if anybody would like, they can join us next month. We're speaking at the New York State Bar Association, and that's on May 13th. And the following month in June 2nd, we're speaking at the New York County Lawyers Association for 2 hours and for 2 hours of CLE credits. Thank you. With that, I'd like to turn the floor back over to Maisha.
Yep. Thank you very much, Henry. And we're just about at the end of our time here. So if anyone has to, get to the next appointment, we understand. But in the meantime, I think we're all going to try and stick around for a few minutes and answer a few questions. Thank you, Cy, Henry, and Matt for sharing your thoughts. I see one more question from David Sterling coming in about life insurance trends and the evolution from a no commission or fee-based commission life insurance policy versus the traditional model, and whether there's any trade-offs that implicate any of the things that you've discussed or more general.
Yeah, thanks for the question. The current system basically is not working because the agent or the broker does not have a financial incentive to go back and service that client. Even now with the new best interest rule, there's no incentive, forget incentive, there's no direction for the agent or the broker to go back and monitor a service. What I've heard in the industry is that this is going the direction of the RIA, where the individual account executive, registered rep will, instead of getting paid 50% upfront, will instead be getting a smaller upfront commission and will be earning perhaps a larger service fee each and every year that the policy remains in effect. It's the right way to go, and fully support that contention. Thanks for the question.
All right, well, not seeing any other questions. I think we'll call this a wrap. If anyone has any questions afterwards or can think of anything, I believe everyone's contact information is in the registration materials. We'll also send up a follow-up email with that information. If you have any other questions, feel free to email info@frblaw.com, and we'll make sure it gets forwarded to the right person to answer that question. We thank all of you for spending your afternoon with us, and look forward to seeing you in the future.
Hey, I have a question, Mike. Again, anyone who needs to go, again, program is over, but I just have a question for Matt. Matt, you mentioned the STEP Act. What do you think the chances are in terms of the retroactivity going back to January 1st? What do you think the chances of that passing are?
It's a great question. As it gets later in the year, I think the chances go down. And the reason why I think the chances go down is because people generally, there's a sense of fundamental fairness about people's activity during the year. And if you go back and you make everything retroactive in terms of, something that passes in September, October, you make it retroactive to January 1st of that year, there's a certain sense of fundamental fairness that just gets violated. And I really don't think, people believe that the Democratic Party is a monolith. It kind of isn't. Joe Manchin and Bernie Sanders are not really the same. To have the most extreme examples in the Senate. Or like Abigail Spanberger is not the same as Alexandria Ocasio-Cortez. They have different views. There's a blend, there's a spectrum. So I just don't think that the Joe Manchin, Abigail Spanberger wing is going to go for a retroactive piece of legislation. I don't see that happening. I think for it to be retroactive, they'd have to pass it within the next 60 days, which I do not think is happening. So if I were a betting man, I would put maybe 5-to-1 odds, 8-to-1 odds against something being retroactive. I don't see it happening.
Okay. And Cy, people do have, a bit of time, but what do you think is going to happen in terms of the 10-year rule? I know you've mentioned that you're in touch with the IRS, but how do you think the IRS is going to come back? What do you think they're going to come back with? Cy, you're muted. Mush, can you unmute Cy?
Yeah, I've asked him to unmute himself.
Okay, I don't think Cy is.
Okay,
now we hear you, Cy.
I can say this. There have been meetings at webinars by a lot of firms, and some of the people at the webinars have said that they've had informal discussions with people in government, and that it was an error in the publication 590B with some parts of 590B. With respect to my email to IRS and Treasury, they thanked me, and they said they were aware of the issue, and truthfully, they're looking into it.
They're calling it an error?
They didn't say it's an error. The scuttlebutt is it's an error. Private programs, and people have been at private. I entered a program. I think some brokerage firms did a program, and people in the program said they've heard from people within the IRS that there's an error and they're going to correct it. But that's double hearsay, or single hearsay. The response to me was, "Thank you very much," from Treasury and IRS, and they were happy to hear from me. They were aware of the issue, and they really, didn't say much more. So everyone suspects that within a month or two, IRS will come out with the proposed regulations that the country's been waiting for, to spell out all the rules and cover the real score in the proposed regulations. Now, they could come out with either a notice as to this 590B business or through the proposed regs. My thinking is, and it's my guess, if I'm sitting where IRS and Treasury is, I would think that the easiest way to go about it is to issue proposed regs to say that these are the rules and follow these rules. Will they come out and say anything more in terms of a straight up and down rule? I don't know. But the consensus is, and it's being written up all over the country, I want you to know. Newsletters are coming out, seminars are going out, webinars are going out, as to the fact that most people said that the 9-year payout within the 10-year period has no authority under the Secure Act. So most people who are attorneys are saying there's no basis in law to say that you've got to take pieces of distributions for the first 9 years. I could not. Can you hear me? Can you hear me?
Yes. Yes.
Oh, you can't hear me. Yeah. Okay, fine. So basically, it's a diplomatic and a political issue from the government's point of view. I think they may just say that this is a clarification of what the rule is, and do it that way. Yeah. By the way, are they giving out our outlines to the attendees, or shall I email, or you email them the outlines? Moshe apparently didn't have the outlines in advance to the attendees, and I just there's a lot of stuff in there.
Yeah, we can email them out. I'm dropping the link in here now to the PDF of your outline, Cy, and we'll include that in the materials that are sent in follow up to everyone.
And
sorry.
I'm sorry. And on that point, Moshe, perhaps I have some handouts. Perhaps those could be a link. The handouts could be sent out to the attendees as well. Again, I think the important point is that Matt, Cy, myself, we're here as active resources, and we've spewed out an awful lot of information. And unfortunately, we may have spent more time on uncovering some of the problems than the solutions, but the solutions are part and parcel to this webinar.
The other point I want to make is that the accounting. Are there any CPAs in the audience, Moshe? Can you tell? Any participants?
I believe that there are. So.
There are? Do you know how many? Do you know?
Not off the top of my head.
Okay, so here's what I can say to you. There's going to be many webinars in the country. Henry is involved in the New York State Bar, the County Lawyers Bar, and a lot of things. I am getting involved with the accounting profession as well. And there will be a nationwide CPE program in the country on June 17th. Probably be, I don't know, several 100,000 invitations being sent out. It will be a CP webinar on the Secure Act rules, and basically it's a credit-bearing program because accountants tend to like credits. So that was firmed up this morning. I just want you to know that. So accountants will be getting maybe 300,000, 400,000, 500,000 emails going out for that event in June 17th, I believe is the date. In any event, thank you for your helping me, Henry and Matt and Mike for being such a great moderator. And you're cool, let me tell you. It was a pleasure to be working with you and your firm, great firm, smart people, and enjoy working with them. And there'll be many more of these programs throughout the country. Thank you.
Moish is cool like John Coltrane. That's why he's got the saxophone in his background.
I saw that sax. Saw that sax.
That's right. Well, thank you, Cy. It's a pleasure working with you two, and the admiration's definitely all in your direction. So thank you everyone for joining us today. And I think we'll call that a wrap.
Thank you, Mike. Thank you, Cy. Thank you, Matt.
Thank you.
Thank
Have
you.
a good day.